Go for it.
The title of this presentation is how to combine three market indicators with one killer strategy to win over 80% of the time while paying almost zero attention to your trades. So I think you're going to like this. So to make money in the markets, it's very important to have great tools for market direction. We know that. That's what this presentation is all about, this whole 3 days. And these three indicators and one killer strategy is going to help you do that. So I've been trading in the markets for a long, long time, as you can see. And even though you're going to see three great ways to tell market direction, or an individual stock's direction, I'm going to show you something even more valuable, how to make money even if your indicators fail. So this is kind of exciting. And in this short presentation, I'm going to reveal a complete system for creating wealth quickly and safely. And the key to this, when we go out to trade, you know, it's so interesting when you start trading. You don't, obviously, we all want to make money. I mean, that's the goal. That's why we get into it in the first place. But you start figuring out what's important and what's not. And this is what I'm going to show you is an options strategy. And options are really exciting because they have this big, wide continuum. And so on one end of the continuum, it's really speculative and really risky. That's what a lot of people focus on because people love to buy lottery tickets. They love that idea of spending a really tiny amount of money and having the potential of it just, you know, just absolutely exploding. And, you know, they just kind of get rich off of one trade. That's really an intriguing, attractive kind of an idea to run through your mind. When you go out there and you start doing it, and I've literally been trading options now, gosh, since about 1996, and I'm in the market every single week. I've traded every strategy there is, and the conclusion that I came to after many, many years of making money and losing money is I needed to really stack the probabilities in my favor. And I'll tell you something kind of funny. When I started trading, I thought my edge, my probability stacker was me, that I was so smart and so clever and so quick on my mouse, I was just going to make a fortune. And I think one of the greatest aspects of being a trader and getting into the markets is the humbling aspect that it has. And it wasn't too long before I figured out, actually, maybe I wasn't quite as smart as I thought I was, and I needed to go back to the drawing board. So that's what I did in a big way. And so everything I do now stacks the probabilities in your favor the minute you put on a trade. And that doesn't, I mean, just so we're all clear here, that doesn't guarantee you're going to win. There always has to be some possibility in there that the other guy wins. That's what makes it a game. And that's what makes it fun. If we won all the time, and nobody would want to play with us. So, but there is something called stacking the deck way, way, way in your favor. And that's what we're going to do. So first we'll use these three indicators. And we want to stack the odds in our favor right off the bat. So let's talk about what these are. Some of these you may already use. Some of you might want to take a glance at, and some of them, or you already kind of glance at before you do a trade. Some of them you might need, even if you're a really highly technical trader, you might need a little refresher on these and how they can be used and how valuable they are. So the first indicator we're going to use is Bollinger Bands. And what I love about Bollinger Bands is they kind of set the range of the stock, and they don't perfectly. I'm just going to get my little red pen here so that I can draw a few things. So what's amazing, and John Bollinger, he's still alive. He's down in Los Angeles. He came up with this indicator many years ago. And all it is, it's not super complicated. All it is what these blue lines on the outside represent is 2 standard deviations from the mean. And this red line in the middle is the mean. So they mark the high and low points based on the bands. And what they do is they provide a relative definition of high and low. And what that means is it's not an absolute high or low. Like for instance, so what you don't want to use Bollinger Bands for is to determine when something, you know, you should absolutely, you know, go long or go short. So let me give you an example. So as you can see, the Bollinger Bands are very effective at containing most of the market movement. But what can happen is you can hit down here, and this red bar, I mean, huge gap down. I don't know what the news was here, but it must have been really nasty. Huge gap down. And then when the trading actually started, it actually went below the second standard deviation. But here's what's interesting is it continued on that path. So it followed this Bollinger Band down for quite a few days before it suddenly reversed higher. So if you put on a call spread, right, or bought a call right here in anticipation of an immediate reversal, that's not what Bollinger Bands are for. But what Bollinger Bands work very well for is telling you when something is getting overbought and oversold. So typically, just if you're a techie and you want to know, typically the middle line is a 20-period moving average, and that's flanked on either side by 2 standard deviations from the red center line. These 2 standard deviations tend to contain the vast majority of a stock's movement. So you can kind of see, it's like the analogy that I've heard used is the further a stock gets from the mean, the further a stock gets from that red line, the more the rubber band is pulled and stretched. And it might extend a little bit further from that red line, but it won't go far before there's some kind of a reversal. There's some kind of a bounce back. This gives you when you're just out there looking at a chart, this gives you some parameters. It gives you a really good idea of when we're getting close to a reversal. Tell you something else that's kind of interesting. I don't have it drawn on this particular chart, but if you go out 3 standard deviations, once in a while, when there's really something incredibly dramatic that happens, a stock will hit the 3rd standard deviation, but it never travels along it. It almost immediately snaps back towards the mean. So this can give you a really great idea of what's overbought and oversold. So the math John Bollinger uses tells us that 95% of the price action will be contained within these bands. In my observation, it's more like 90%, but it's very, very high. It's the vast majority of price deviation, and it's useful for determining potential reversal points. All that means is that when it hits that 2nd standard deviation, probably there's going to be a reversal happening. So even in the extreme case, like the one that we used right here, we went 4 periods. And so if you call this days, or it could be hours, it could be any units of time, there's 4 of them that went along the line before we got a reversal. And in this case, a standard reversal. So if you just look at, and this is all very typical, a lot of the time, I mean, here, if you see up here, it got hit several times and then it reversed. And then it went down here, actually exceeded the 2nd standard deviation, but it wasn't too long before it bounced right back up again. So if you're looking for turning points in the market, and that is typically where most people make their money, this 2nd standard deviation is a really great way to just band whatever stock you're looking at and just see, is this thing massively overbought or oversold? And usually, almost always, those conditions do not remain for long. So they have a 47% success rate when you go long at the bottom or go short at the top. But we're going to improve that success rate. So right now, what we're doing is we're putting kind of parameters around the movement of the stock, and we're looking what Bollinger Bands are going to tell us is when things are overbought and oversold. It doesn't reverse immediately, but it will, and it probably will soon. So our next indicator, and this is one that is very commonly used. A lot of people use it, look at it, don't really know what it is, or don't really know how to effectively use it. It's one of the most common technical indicators. The reason I like common technical indicators and not something really, wild or exotic or weird is because the market is a voting machine. So that's why really, really common technical patterns work so well. If a known support is broken, everybody kind of agrees. I mean, anybody that watches charts at all agrees, oh my gosh, that super strong support's broken. This thing is probably going lower. When a resistance is broken to the upside, that's called a breakout. They call it a breakout for a reason. This thing is probably going higher. So the most common technical analysis tools are actually, interestingly, the most effective because more people adhere to those tools and more people use those as indicators of when to take action. And it's those actions that make stocks move. So this is the moving average convergence divergence. You probably heard of it before, otherwise more commonly known as the MACD. So the MACD is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. It's an oscillating indicator fluctuating above and below 0. It's both a trend following and momentum indicator. So here's what you're always looking for with your technical indicators. People say, why look at technicals? Why are they important? Why should we use them? What you really want in your technical indicators, where they provide value for you, is giving you a crystal ball. And if you can see, if they can help you see a little bit into the future, a little bit of what's likely to happen. Once again, this isn't 100% of the time. This is using technical indicators to stack the probabilities in your favor. So here's what I mean by a crystal ball. So we have these two lines moving here. So these are two moving averages, the 26 exponential and the 12 exponential. What a lot of people do is they say, well, I'm going to trade this at crossover points. I'm going to trade. So let's just take a look at this crossover point. So if we go directly up on the graph, when that crossed over, you would have made the trade right here. Let me give you a little bit more effective way to use a MACD. Look at the histogram. So here's the histogram down here leading up into this trade. The histogram peaks right here and the histogram starts going down. When the histogram starts going down, it really doesn't whipsaw much. I mean, when it starts going in a direction, it's going for a while. So at what point did we see that on the chart? And that is right about here. So what this histogram is telling you is that this thing is rolling over. It's going down. In some cases, you can even get, let's go on to the next screen, see what we got here. So in some cases, you can even find some divergence here. And that's what we're always looking for, where the histogram is going down and the stock is going up. That really gives you some advance warning. So one basic MACD strategy is to look at which side of the zero the MACD lines are on in the histogram. So that's what we've just talked about. So you have bearish here. You obviously have bullish here above the line. Above zero for a sustained period of time, and the trend is up, obviously. Below zero for a sustained period of time, and the trend is down. Potential buy signals occur when the MACD moves above zero, and potential sell signals when it crosses below zero. Signal line crossovers provide additional buy signals. We've talked about that. So this is what a lot of people use whenever these things cross. And what I'm telling you right now, and this is typically how they're used, but what I'm telling you right now is that that gets you to the party, and it can be used as a good indicator, but it gets you there a little late. And in a lot of cases, the majority of the move has already happened. And I'll give you a good example of, see this one down here. So if you're using this as a crossover, you come up here to the screen and you go, okay, it's going long now, and you go long right now. What do you get out of this trade? It pops up a little bit here and then freaking rolls over just almost immediately right here. So not good. We're better off to use the histogram. And what I like on the histogram is when it's a little bit overextended in either direction, because it gives you more of an indication you're going to get more of a snapback towards that mean. So back to our example right here, is this particular mountain is higher than all the other mountains. That gives us a really good indication it's overbought. So when this thing starts rolling over, you've got some degree of certainty that that thing's going to go down. If you see a little bit of bump like this, not so much. But when you see a big mountain like that in either direction, big mountain or a big valley, that's a really good indicator. Okay. So the MACD performs best during trending markets, especially when combined with the MACD crossover. The challenge for most traders using the MACD is once we just talked about this, but I'm just reading my own writing here, is that once the MACD crossover happens, how much of the trend is left? But combined with the right strategy, the MACD can be very effective. So once again, what we're looking for is the crossovers are great, but they come a little late. So we're looking for this change in the histogram, and the more deviation from this zero line that you can get, the better. Is when it changes directions, it's probably really going to change. So that's the MACD. So we've got the Bollinger Bands. We know when something's kind of overextend. We can see the Bollinger Bands up here. This is touching the Bollinger Band, but you can see it's touched it for 1, 2, 3, 4 time periods. So when is it likely to roll over? We just go right down here to the MACD. Tells us the exact moment it's starting to roll over. We would get in this trade probably somewhere in here, or you could get in this trade with this indicator. That gives you a lot of downside. That works pretty well. Okay, so here's how we're going to use it with our strategy. So I'll just let the cat out of the bag right now. We sell put spreads when the trend is going up. We sell call spreads when the trend is going down. Now, hold on for a second. If you know options and you're sitting here right now going, oh, well, Peter, I know all about put spreads and call spreads. You're not telling me anything new. Just stick around for a little bit because we've had a lot of really good success with this, and I can just about guarantee you'll learn something new. But this is a really good way to use this particular indicator for when this thing's going up, you're seeing it go up. You can see this peak right here, which actually corresponds. Fortunately, we have a nice little line here, and it corresponds the peak in the histogram, or the valley in this case, the absolute low point in the histogram, corresponds with the low point in this particular stock. So once we see that, it's nothing to put on this would be a bullish position, would be a put spread. Bearish position is a call spread. This is very, very effective for reasons I'm going to show you in just a moment. Okay, our third indicator is on balance volume. And when you first got into technical analysis, or maybe you're just getting into it now, either way, the two big components that form every indicator out there is price and volume. Now, why is volume interesting, or why is volume relevant? Because once again, the market is a voting machine. So it's how many people think something's going to happen. So if a stock breaks out and it's just on this huge amount of volume, that indicates that a lot of people think that stock is going to keep moving in that direction. That's powerful, and that's important. That's good information for us to have. If not very many people, or there wasn't very much volume on that move, there's a pretty decent chance that move is going to reverse. That's why volume is important. So on balance volume gives us even more information. So volume itself is a valuable indicator, but on balance volume takes a lot of volume information and compiles it into a single one-line indicator. The indicator measures cumulative buying and selling pressure by adding the volume on up days and subtracting the volume on down days. And then it forms a line on a chart that you can look at, you can read. And I'm going to tell you why this is important and how you can use it. Ideally, volume should confirm trends. A rising price should be accompanied by a rising OBV. A falling price should be accompanied by a falling OBV. If it doesn't confirm, look for a trend reversal. So as you can see on the on-balance volume, it's been trending consistently lower in spite of some pretty big intermediate term rallies to the upside. This continuous downtrend tells us to sell the rallies as more downside is likely coming. Obviously, the reverse is true when on-balance volume is rising. So let's just take a look at the general trend here. So you could have gone into this and you start looking at this stock right here. And you go, oh my gosh, this thing is going higher. It's just going to go to the moon. It's going to break out. In fact, we even had a high right here, slightly above this high. And you're going, this is it. And maybe all you can see is, your last candle was this one right here, and it's looking really, really bullish. Well, if you go down here and you follow this all the way down, and number one, you have the MACD, or number two, I should say, because number one is our Bollinger Bands, but number two, you have the MACD histogram going on, and going lower. So that's going to give you a big cautionary red flag up here at the top. But here's what you also have is you have this overall downtrend line on balance volume. And if you look at where this happens, it corresponds to the top. As soon as this starts to roll over, the very next unit here, the very next candle, the very next bar is just slightly red. It's not some big sell-off. It's not horrible. It's just slightly red. But you look at this, the histogram's already going down and the on-balance volume is already going down. So this thing is peaking. And you're wondering, gosh, we've had a heck of a run off the bottom here. We have a slightly higher high. Is this thing going to just keep on going and going to the moon? Well, you have three really. So you have Bollinger Bands telling you that you're at an extreme. You're at the second standard deviation. So that's one potential sign of a reversal. You have the histogram starting to turn lower, very strong sign of a reversal, and on balance volume is confirming that. So this would have gotten you out of a lot of trouble if you were thinking about taking a bullish position on this quote unquote breakout that's slightly higher than this over here. So what these indicators are designed to do is, it's just like a pilot. When they get their pilot's license, there's something called visual license, where they can only fly if the air is clear, it's blue skies, they can see all over the place. But then they can get this instrument certification that allows them to fly in situations where it's really, really cloudy or fog or whatever. They can't see a darn thing out of the windshield. How in the heck can they fly this airplane with any degree of safety? Well, they do it with their instruments. And their instruments tell them what's going on, even though they can't see out the windshield. So that's what these indicators are doing for us. Things are happening on the chart. It's looking good. Should we get in? Should we go long? Should we buy some stocks? Should we buy some calls? And then we have these indicators that say, well, slow down here. I mean, this thing looks like it's going to reverse. Let me see if I've got another. Yeah, so what's also a really, really strong indicator and will really kind of get you more into that crystal ball territory where you can see what's coming is on divergence. So when one of these indicators or two or three of these indicators are diverging from the direction of the stock. So this is key. This will not only keep you out of a lot of trouble, but it can make you a lot of money because it helps you anticipate when there's reversals. If you can get good at identifying reversals in the stock market, you can make a heck of a lot of money. That's kind of where all the money's made. When that reversal happens, it's often fast and furious. And then within just a few time periods, a few days, whatever it is you trade, it starts to slow down. So that a lot of that money is available right in the very beginning. So you look for divergences between indicators to try and pinpoint market reversals. Most often the market reverts to its previous trend, and on-balance volume confirms that trend, even if the market reverses temporarily. So here's a good indication. We just kind of use that, but this is a little bit more delineated. This thing is going up. So you see a really strong uptrend here. I mean, there's some big green bars and it's higher highs. And I mean, look at this thing right here. I mean, it just jumps straight up there. Very, very impressive. And the entire time, the on-balance volume is making not just tiny, but dramatic lower lows and lower highs. So what this tells you, the on-balance volume, what it tells you is the overall market, the big voting machine, the majority of traders and the majority of buyers and the majority of the stock that's trading hands, they're not buying it. So what's happening here when something goes up on relatively low volume is there isn't, it's like almost like an absence of sellers. There isn't a lot of buyers, but the few buyers that are out there are driving this thing higher. Well, that's not a lot of conviction, just a few buyers and hardly any sellers. That's why when it gets kind of overextended and it gets overbought, I mean, something happens and this thing turns lower. And all of a sudden the sellers show up and the on-balance volume reflects that. Far more sellers than buyers. These are three indicators, and what I like about them is they're fairly simple. They're available on any trading program. You don't have to buy anything from me. I'm going to maybe give you some good reasons to come on board with me here in a few minutes, but these are available to you on any trading program. Your broker has them. Any chart service that you use has them. These are common indicators that you can find. And I hope they can do you some good. One of my complaints about technical analysis is people get into it to the point where they start having 4, 5, 6, 7, 8, 9 indicators. There's so many lines going across a chart. The stock is bound to hit one of them. It's like somebody threw spaghetti at your chart. And the problem with that, that's great, if you have some stuff that you like, but the problem with that is if the stock is always touching one indicator to another, you're sort of going, well, which indicator do I trust? Which indicator is going to give me the most likelihood of identifying a reversal? So these are some fairly simple indicators, but I think they're pretty good. I mean, in my experience, they're pretty good at identifying reversals. And that's important. Market direction is important. So Yeah, and what this slide is just telling us is combine your indicators. So here we have our first indicator, number one, Bollinger Bands. It's at an extreme. It's at the second standard deviation. That's a potential turning point for the stock. Number two actually identifies a turning point with our MACD. So now you got confirmation of that. And number three, we've got a point here where the on-balance volume is already creating lower lows and lower highs. And now we've got a point specifically right here where the on-balance volume is starting to turn lower. Look at when you could have gotten in on this trade. You could have gotten in it before all of that movement. That's a lot. And you'll notice, you go, okay, great. I've got a great put trade going on, or I got a great bearish trade. When do I know when to get out? Well, right here. It actually, the bottom of your valley is actually right here. So it's actually before the thing bottomed. That's giving you some really nice advance warning. It starts to tick up here. So you would have had a good indication here using this same three indicators of when to get out and take your profits. So I hope that does you some good. Like I say, I mean, you can do this totally on your own with whatever strategy you want to use. But the name of this presentation was how to combine three indicators and one killer strategy to win over 80% of the time while barely paying attention to your trades. So these are the three indicators. Once again, I hope they did you some good. I love them because they're simple. They're easy to understand. You can see what's going on at a glance. So let's take a look at what that killer strategy might be that's going to combine these and really give us something that we can use. So the beauty of these three indicators is they're not correlated. They work together to confirm a trend or mark a turning point in a trend. When all three tell you the same thing, you've got an extremely high probability setup. They work well for directional trading, but they work even better using a strategy that gives you a massive probability of winning. So we're back to this theme. Can you see a theme developing here? We're looking for putting some probabilities on our side. So, you know, all else being equal, we win. So what's the best strategy to give you a massive probability edge? What's that killer strategy that's so effective you can make money even if you don't time your indicators perfectly? The trick to making money quickly, easily, and consistently using these three indicators is to use a strategy that stacks the deck overwhelmingly in your favor on every trade automatically. And why is this automatically important? You know, I find out something really interesting early in my trading career. The more I'm in there, clicking my little mouse and looking around and trying to get in and get out and second guessing myself and all of that, I would just emotionally, it was my own emotions were my worst enemy, and I would actually end up losing money. You know, fear, greed, this, that. You're always making the wrong decision at the wrong time. I needed something that overcame that, where I could make money in spite of myself. And after a lot of trial and error, I found something that works extremely well. So the key to winning over time is to stack the probabilities on your side. So we've established that. The way we'll do that is to use options because of their built-in probability of winning by switching from being an options buyer to being an options seller. And by doing so, we'll instantly stack the deck by over 80% on every trade. And our three indicators increase that probability of winning. So remember when we first started talking about options, I said, well, at one end of the continuum on options, you know, it's super speculative and everybody, you know, decries options and screams and yells and says they're too risky and you can't do them and blah, 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 blah. Well, what's cool about options is you can move all the way to the other end of that continuum and you can set up trades that have a much higher probability of winning than stocks. So on that end of the continuum, I would argue with anybody. In fact, I'm going to show you right here that the options trading this way is safer than stock trading. And when things do go against you, you lose a lot, you have less money at stake. So it really, it's especially great for people that have small accounts, but it's good for people that have big accounts too. It works. So here's the killer strategy. We're going to, hold on a second. We're going to sell out of the money credit spreads that have an 80% or better chance of winning no matter what the market does. So here's here's how that's going to work. So this rising wedge pattern suggests we could see a pullback at least down. Now, what this commentary is, what I wrote up here, this isn't something that I put together for this presentation. This is, I have a trading service. I've had it for, gosh, going on over 25 years now. It's been really successful. I've got people with me that have been with me for a decade or more. So this is actually from my service. So you're getting an inside look on what I'm actually telling all of my subscribers. So this rising wedge pattern suggests we could see a pullback at least down to the upward trending line, support line, before a sustained move higher, which is why we're going to sell a call spread above resistance on an index rolling over. So here's the strategy. So we're going to sell a call here, and we're going to take in, a decent amount of money. Pretty good. And then we're going to buy a call here to hedge, and we're going to take in a smaller amount of money. Because the money we take in on the sell is greater than the money we take in on the buy, we end up with a credit in our account. And if you don't know what a credit is, what it means is you have more money in your account than you had before you made this trade. And here's the just amazing thing about this strategy is you get your money instantly. You get it right away. So the minute this is really different than the way everybody else trades, but the moment you put on the spread, you get money in your account. So you get paid up front. And you say, well, how can I sell something if I don't own it? Well, that's just how options work. You can sell a call or sell a put to open a position. It's really cool. So we get this credit, and that is the basis of how we make money. But here's what's interesting. So with standard options, and this is kind of the speculative end, this is where everybody lives, this is where everybody trades, is they'll buy a put on a stock they think is going down, and they buy a call on a stock they think is going up. Okay, that's great. Wonderful so far. The problem with that strategy, and the reason so many people lose so much money, is because you have to be right, not only on the market direction, which as we know can be challenging, but you have to be exactly perfectly right on your timing. So one of the great jokes among options traders is that the stock did exactly what I wanted it to do the day after expiration. So it's like, yeah, you were right, but you lost all your money. So here's an example right here is, okay, if you're to buy a put on this thing, you need this thing to drop. You need it to drop dramatically in order to make any money. But if we sell this spread up here, and I'll just tell you the game here, the object to this spread is for it to not, our sold strike, which is this bottom one that's closer to the underlying, we don't want our sold strike touched by the underlying stock. And what I would propose to you is that it's a lot easier to pick where the stock is not going to go than to pick exactly when and where the stock is going to go. So when people buy short-term calls and puts, they need that stock to do something, and they need it to do it fairly soon. Stocks are kind of like teenagers. Anytime you want them to really do something, and they seem to sometimes go the other direction or do the opposite. It's a little bit, can be frustrating. And probably the easiest way, let me see if I've got this on a screen again. So here we are again. I'm going to talk about this one here in a second, but look at this. I want you to see something here. There's only 5 things that a stock can do. So here's the 5 things. So say it looks like we initiated this trade. Oh, and by the way, what this line is here, this line is the finish line, okay? That's expiration. What that means is you never have to worry about exiting the trade because it all happens for you at expiration. Now, if your spread gets threatened, I'm going to show you how to set up automatic orders to get out of the spread at more of an advantageous time than just letting it go. But I mean, this is such a hands-free way to make money, and the probabilities are still stacked in your favor. And I'll tell you one of the reasons why. So we put this trade on right here. So we think this thing is probably going to go lower. So we sell a call spread. So there's 5 things and only 5 things that a stock can do. It can go up dramatically. I mean, this thing can shoot through the roof. It can go up kind of, it can go up, but just not as dramatically. It can go sideways. It can go down a little bit. It can trend lower, or it can go through the roof. So when we put on this call spread, when we sell this call and we buy this call, that's called a credit spread. When we put that on and that happens, the only way we can lose on this thing is if suddenly the stock goes up dramatically. This one right here, this is an X. That's when we lose money. But we've already taken a look at our 3 indicators, and we already see, just without even any indicators, that this thing is starting to roll over. Probably not going to happen. So if it goes against us, but it just goes against us a little bit, we make money. If it goes sideways, we make money. If it goes down a little bit, we make money. If it goes down a lot, we make money. So 4 times out of 5, and that's, I'm going to show you more specifically, but just roughly, if we look at this, that's an 80% win rate. So the stock has to do something that's very, very unlikely for it to do in order for us to lose. Sometimes stocks do. Sometimes a hand grenade gets thrown into the markets. Sometimes there's a scare, a spook. The Federal Reserve does something that nobody likes. Who knows? Sometimes that happens. But more often than not, exactly what these trend lines and these setups and these indicators tell us are what's going to happen. And if this stock does anything but just suddenly go through the roof, excuse me, we're going to make money on this trade. That's why our probabilities are so high. So here's a stock. Oh, and actually, I'm going to go back real quick because I want to show you something. So we took in some money here on this in this actual situation. This is a real trade. We took in some money on this call spread, but then the thing went down here, went down a fairly strong horizontal support and bounced off of it. And we sold a put spread, took even more money. This is when this starts turning into a super profitable strategy. So you can do both of these. Some people call these a condor, an iron condor, but you can sell both sides. But you don't put these condors on. What's one of the mistakes people make, I think, is they put them on at the same time. What we want to do is put them on to our advantage. So when the stock is at an extreme high and it looks like it's going to roll over, we'll sell a call spread. When it's at a relative low and it's starting to bounce higher, we can put on a call spread and really juice our returns. So this stock, I'll show you 2 different times. This is went down here, bounced. As you can see, it bounced. If we had our indicators, it would confirm that. It put in a new high right here. So it's really taking off. This is a big volume day, big movement day. We put on a put spread here. We're shooting for a 25% return for a very short period of time. This is about a 10-day calendar day, actually 9-day period of time. Take out 2 days for the weekend. You're only exposed to the market for a week. It's actually pretty sweet. And then it did it again. So we had this big gap up. There's still enough premium for us to sell a put spread down here. Put spread here made money, and then another good setup. Put spread made us money again. As you can see, your likelihood of winning is high. I mean, I'm going to go into the actual what you see on the on the chart, but or actually the mathematical probabilities, but it really is good. So this is UPS. They've been a good bearish trade for a long time. Every time UPS kind of gets up to kind of a high reversal point, it's just one of these things. It's like a cow. You can just keep milking it, and it's pretty easy to do and pretty dependable. So here's the commentary. UPS has jumped over the past week based on earnings hype, but the economy is weakening, so earnings will likely reflect that. Plus, the momentum is rolling over. Just a perfect time to sell a call here, buy a call here. This case, we took in a 57-cent credit. This was a $2.50 spread. So that left us $1.93. That's our potential loss. That's what we divide by. So if you have a 57-cent gain on a $1.93 potential loss, that's a 30% return in just 9 days of time with an incredible high degree of safety. That's pretty sweet. And if you go, well, Peter, I'm trying to make some money here. 57 cents doesn't excite me. Well, options come in 100 share contracts. So right off the bat, we've got $57 there in profit. Well, that's one contract. 10 contracts is $570. 100 contracts is $5,700. So you can bring in as much or little on these trades as you're comfortable with based on your own risk tolerance. This is more of a typical one as far as our return. Here's the commentary. The SPX is having a hard time recovering its previous uptrend. The big index made it up to its old uptrend line, but that often turns into resistance once broken. With so many big cap stocks trending lower, the SPX most likely will trend from here is down. And certainly it was. And so what happened is this kind of important horizontal trend line got broken, went down here, and then it bounced up. What often happens is on the recovery, old support becomes new resistance. It touched it once, twice, 3 times. Time to put on a trade. All of our indicators look like, here's the MACD. Oh my goodness. We even have a crossover here. The histogram is heading lower. Time to sell a call spread. We took in $1 credit on a $5 spread. This is really easy math. So the most you can lose on any of these is the distance between the spreads. So that's $5. So the distance between the call that we sold and the call that we bought is $5. But we already took in $1. So we can't lose that. That is money that's yours to keep forever and ever. So that's your potential profit divided by 4. And this thing just expired worthless. Divided by 4, that's a 25% return. And that's typically what we target, typically what we shoot for. So before I said just roughly, you have an 80% chance of winning. Well, this particular trade, the thing I love about options is you can see your exact probability of winning before you go into a trade. So this is great. This is the Thinkorswim platform. It's what I really like. When you come on board with me, I'm going to show you how to set up your screen. This is the layout: implied volatility, probability of out of the money, and delta. Your probability of being out of the money, and if what we sold is out of the money, we keep all the profit and we win on that trade. Your chance of winning is 81.99%. Let's call it 82%. So, what I often tell people is if you could flip a coin and win 82% of the time, and every time you won $1,000, how many times would you flip that coin? And that's exactly the situation here. So, this is just a really strong downtrend. This is a really obvious one. We initiated the trade. We see some horizontal resistance here. Things kind of rolling over, looking bearish. Took in a 51-cent credit. This is a $2 spread in this particular case, and that is a 34% return. But you can see by looking at this chart, it's probably not going to bounce higher. Things are looking bearish for this thing. So to sell a call spread out of the money above resistance is a pretty, for a short period of time, pretty safe bet. Oh, this is the commentary. This was on the route with a huge short covering rally it had a while back. The only mechanism that can create this kind of straight up rocket launch is short covering, and the CPI print lit the fuse, up a whopping 114 points in 4 days to highs not seen since early 2022. Yeah, but look what happened. So we have our indicators here. They're heading lower. These things run out of steam. We took advantage of all of this volatility, sold $1.11 credit divided by 389, 29% return in a very short amount of time. Hit expiration. You don't have to exit these trades. They just expire worthless. You're off somewhere taking a nap. You make money. So your odds of winning are extraordinary, but the real appeal might be your ease of trading. So once you put on a trade, you simply enter a stop right where I'll show you, and you walk away knowing you have over an 80% chance of winning. And even if you don't win, your potential losses will be cut in half based on the automatic orders. I'll show you how to enter. I'll let the cat out of the bag right here. I just want to educate. Even if you don't come on board, I'm really happy if you become a better trader and you can make some money doing this. Set your automatic stop right at your sold strike. If you do that, you cut your potential loss in half. So remember when I told you that your potential loss is the distance between the two strikes. So if it's a $5 spread, it's that $5. If you close the trade when your sold strike is hit, your loss then becomes half of that. That's options theory, tells us the cost of close will be half. So that's only $2.50 it costs you to close that trade. Remember, we took in $1. So think about that math. You have an over an 80% chance of win, and you take in $1 with a potential loss of 250. You can make up a losing trade on just 2.5 other trades, and you're gonna, the probabilities tell us you're gonna win on 4 out of 5 trades. So it's just you have a mathematical probability expectation of winning. It's a nice setup. And so we target 25% per trade. I want to tell you that we do that. Sometimes we get more than that, but sometimes you lose on trades. I mean, that happens, and you lose a little bit more than you win with this strategy. So we have to factor that in. So, with holds, buybacks, losses, what is your expectation of what can you possibly make? Is it 20%, 15%, maybe 10%? I know a lot of people, a lot of my subscribers are doing a lot better than this, but let's lower this to 5%, just 5%. And it's an amount I know anyone can make. And we are only in our trades 9 days to 10 days, but let's just stretch that out and say 2 weeks. So let's just say you're turning your money twice a month. So let's see what just a 5% return looks like, starting with a $10,000 account. I think this compounding thing is going to kind of blow your mind. Look at this. And I know what you're thinking right now. You're thinking, Peter, this is pie in the sky. It never works out that way in the real world. What are you telling me? So the math tells us after 2 years, 10,000 has grown to 104,000, and you're bringing in over 10,000 a month. So here's what it looks like in the real world. But mathematically, it should follow this graph. And I've got a buddy that started with me about 2 years ago. He's a great guy. He's actually the CEO of a company, very successful company. He does this strategy, and we're on the phone all the time talking about it. That guy, he'll call me up so enthusiastic, say, I made 40,000 last month. So 10,000 you might think is pie in the sky. We got people that are doing better than that. Of course, he trades 100 contracts at a time, which is big money. But I mean, there's big money to be made. And if you stack the probabilities, it gives you a lot of confidence. So you can do this strategy on your own, and I encourage you to do it. It's starting with as little as $200 a trade. There is a little problem, though, and that is if you don't do really well right off the bat, you might get discouraged and quit. And that would be a shame, because this really is the best way to trade because of your high likelihood of winning, the hands-free nature of the trading, and the tremendous compound returns over time. So I put together the best education on this particular strategy that exists. I've actually bought everybody else's program. Nobody goes into the detail I do. I do this every week. I've made a lot of money off of this strategy. I love to see other people do well with this, especially because of the lifestyle aspect. You don't have to be so glued to your computer. So I put together an educational package that's the best anywhere for this strategy. It's used to sell this for $2,500. I've been on some luxury cruises, where all the market gurus are out there, and I've sold this for $2,500 in the past and done really well with it. I decided I wanted more people to have access to it. I wanted a bigger client base, and so I dramatically lowered the price while simultaneously improving it and adding things. So the whole program is called The Winning Secret, and it includes how to trade credit spreads for fun and profit. It shows you step-by-step how credit spreads work, why they work so well, and how they can work for you. You get a 161-page downloadable ebook, a 10-chapter video series, archived webinars, everything that we add, you get that. You have, once you come on board with the package I'm going to show you, you have this for life. You have it forever. Any improvements we make, you get it. You can access this as long as we're in business. You'll get videos that show you how to set up automatic orders with our favorite broker. That's Thinkorswim for spread trading. To trap profits. This is great because things happen with or without you. I love that. I'd rather be out doing something fun than watching the market go up and down. And once again, I think you stack the probabilities in your favor, you win most of the time, and you don't have to watch your trades so close. I think that's a winning combination. Now, I've also got a subscription. I'm going to combine it with this package. Now, this has a monthly cost to it. It's 97 a month or 99 a month. I don't even know. You're not going to care, because if the market's paying for it, you won't care. And I've always told everybody, if it's working and the market's paying for it, stick with it. If it's not working, don't stick with it. I mean, I don't want you as a subscriber if I'm not making you a heck of a lot more than you're paying me. That's fair. Good marketing advice market advice should pay for itself. So with this subscription, you get 2 high probability trades every week. And I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum risk. Plus, as an extra bonus, you'll get a 10-module video course specifically on trading the weeklies. And, I know the best way to learn is through one-on-one education. So included in this package is a one-on-one orientation to make sure you get your account set up right and know how to take advantage of this information. That's going through our website. Excuse me, I come out with our trades very late on Tuesday night. So you've got them available to you on Wednesday mornings. This is Deanna. She's going to give you your orientation with just you and her one-on-one. She's going to be able to see your screen, navigate where you go. Even if you don't have an account set up yet, or you don't have options trading clearance, she'll go through all of that with you. Really invaluable. I really believe in this one-on-one. That's how most of us learned how to do something, especially anything that was important and that there were consequences, like learning to drive a car. You probably didn't do that over the internet. You probably had somebody sitting next to you. That's why I think that's so important. And I think that's why you're really going to like this. In this particular package, you get a personal one-on-one coaching session with Alicia. Now, Alicia has an incredible mind. I love talking to her about options trading strategy. She's super sharp. Graduated in finance from her local university here. I was lucky enough to bring her on board many, many years ago. And she's our options trading coach. I hate to say this and never repeat this to her, but I think she might be a better trader than I am. And this isn't, Deanna shows you around the website and what to do and, how to take advantage of your subscription and all of that. Alicia gets into the nitty gritty of making money in the markets. So we have 3-session coaching packages that you can buy. We have 8-session coaching packages you can buy. We've got people that have bought a whole series of 8-session coaching packages back to back. Is that because they're having such a hard time figuring out what a call and a put is? No, it's because Alicia and them get together. They look for trades. She shows them how to look for great trade setups. And then they go out there and they make those trades and they make money. They wouldn't keep signing up for these coaching packages if they weren't making money. So she tells you the theory behind options. She shows you how to, she really, she's absolutely invaluable. You're going to figure that out on your own once you have one coaching session with her. And I'm going to throw that in with this package. Nobody does this. Typical coaching packages for options are $5,000 to $10,000. They're all over the internet. Check them out. I'd put Alicia up against any of them. I think she's better. Plus, you're going to like her more. She's great. She's got a great personality. So you're going to get that included with this package. So this is everything that you get here. I'm not even going to tell you the price. You know that we used to sell this for $2,500. Back in those days, we didn't have an orientation with Deanna. We didn't have free coaching with Alicia. We didn't have several of the things that we've already added to the package. So you're getting so much more. And this is a tiny, tiny, tiny fraction of that $2,500. So if you've got any money, if you're interested in this strategy at all, this is as worth your while as anything you're going to see. And the website that you're going to go to see the entire package lined out for you and the price is worryfreeprofits.com. That's it. We've got just 5 minutes left. I want to leave this a little bit of time we have left open for questions and answers. And I'm full screen right now. I can't really see I can see the chat. So okay, so I've got a question here. Do you have a service to send trade signals, stock setup, entry, and exit, where I can put the trade at my broker and wait for the exit signal? Yes. That comes out Tuesday night. I tell you exactly where to get in the trade. I tell you all the reasons. I tell you, when to exit. Even, we've even got a deal where if it's time to exit early, I'll send you out an email. And because a lot of people aren't on their computers, but they are on their phones, we even have a text service. I say, hey, okay, it's time to close this trade. It's looking a little dicey. Don't have to do that too often. I'm really a lot more into passive trading, so you don't have to do that. But if there is something that happens, and sometimes the market throws us a little curveball, you'll absolutely get an email and a text telling you when to get in and when to get out. Can this be adjusted for use in spot forex? I'm not a forex trader. I know forex is really, really popular, but I suspect it can. But I'm kind of an options guy, and it works. And so you might want to check out a new asset. And we have a question. If you have 10 contracts, would you close out half of them and let them run, or get out of all of them? Well, so we don't really have to get out of our contracts. That's, the idea here is for this thing to expire worthless. We don't have to exit our trade. So that's the big problem that a lot of traders have, is they know when to get in. They've gotten really good at getting in, but they don't know when to get out. And that's tough. And so this strategy kind of takes care of that for you. I show you how to enter automatic orders. So if your sold strike is touched, you're automatically out. So you really actually never make an exit decision. You never have to do that. You put on the trade and, you go sit by the pool or go to work or take care of your kids or go on a hike or whatever it is you'd like to do. We've got a few other questions. Some of them aren't as relevant, but I appreciate the questions, and I appreciate you guys being here. I'm excited about this. I'm still excited. I've been doing it for a long time. So we started our service in 1999. I switched over this strategy just kind of like 100% of our trades starting in 2011. So it's been 14 years now that this is all that I've done. And that's because it works. And if I don't make you money, I don't get to stay in business. So it's kind of performance based, and that's the way it should be. And go to worryfreeprofits.com. I think you're going to really appreciate everything that you get for the price. I'm even including with that package your first month of the subscription, so you can hopefully put on some trades and get it all paid for you, so it's not out of your pocket. That's the idea. Obviously, there's no guarantees, but I'm going to work really hard for us all to make money. I'm in these trades myself. And David, I think we're about out of time. It's been an absolute joy and a pleasure to speak on this subject. So I appreciate you giving me a little platform here. Thank you.